let's jump straight into this fast-paced explainer. We are breaking down all the wild overnight global macro events and getting you set up with actionable technical views for the day ahead. If you're trading today, you absolutely need to know how these moving parts fit together.
And we've got to start wide with the sheer volatility we just witnessed in Asia, 10.8%. That is literally how much South Korea's KOSPI plunged overnight, triggering circuit breakers. We saw heavyweights like Samsung and SK Hynix leading a massive tech sell-off. The catalyst? It's a really potent mix of AI valuation concerns, rising Chinese competition, and renewed geopolitical uncertainty, throwing a massive wrench right into the tech narrative.
And honestly, this perfectly illustrates the violent rotation happening on Wall Street right now. It's essentially the old economy versus the new economy. While the Nasdaq and those high-flying chip makers were left dragging, the Dow surged nearly 550 points. Capital is just rotating fast into traditional names lifted by strong earnings. Think your Coca-Colas, Sherwin-Williams, and Boeings, right alongside some fresh buying and software names like Accenture and Salesforce.
The huge driver for this sudden risk-off tone is the Middle East, which violently woke up the markets. We had the U.S. intercepting Iranian missiles, and Iran explicitly warning that the Strait of Hormuz remains in play. Add in drone strikes targeting Saudi facilities for a second day, and WTI crude just spiked over 4% to clear $82 a barrel. It has been an incredibly wild, volatile fortnight for oil pricing.
So all of this perfectly sets the stage for tonight's massive FOMC decision. Now, a rate hold is largely expected. Markets are pricing in about a 2/3 probability for no change. But with yesterday's data showing consumer confidence slipping and ADP employment staying subdued, it's clear the economy is cooling. Because of that, the absolute linchpin for markets won't be the rate itself, but Chair Powell's guidance. Are we looking at long-term patience or just a temporary pause?
Translating all that macro uncertainty directly to the dollar index, the DXY has essentially flatlined over the last 48 hours, mostly as easing oil prices pulled the U.S. 10-year yield down to 4.61%. Heading into the FOMC presser, our tactical view here is to buy on dips. You'll want to watch for solid resistance holding at 101.80, with support sitting firmly down in that 100.47 to 100.57 zone. Looking across the Atlantic to Europe, the German 10-year Bund yield slipped over 10 basis points from its recent highs. And we had President Christine Lagarde implicitly signaling that, hey, even with constructive inflation trending under 2%, those peripheral fiscal gaps mean caution is absolutely required. Central bankers are making it crystal clear, do not expect a rushed pivot.
So because of that ECB caution, EURUSD remains completely trapped in a tight range. Our tactical bias right now is a clear sell on the rise. Keep your eyes on resistance right at the 21-week moving average of 1.1403. If we get a break below 1.1388, that exposes major support down at 1.1310.
All right, moving over to the UK. The economy continues to exhibit some green shoots, and cable initially rose sharply on the back of that rising oil we talked about. But then it tumbled nearly 250 pips. That's a full 2% drop from its peak. Why? Mostly just good old-fashioned profit booking and some creeping fiscal uncertainty. We also saw the UK 10-year yield slip back below that ominous 5% level.
Mirroring the euro setup, the pound's technical structure is heavily favoring a sell on rise. Key resistance sits right at 1.3326. If the sellers really step in, watch for heavy supply resting lower down at 1.3265 and further down at 1.3150.
Now, over in Japan, we are watching a massive, unblinking poker game. You've got the markets and yen bears relentlessly pushing the pair up on one side, and Japan's Ministry of Finance and the BOJ on the other just holding their ground with no intervention yet. Falling oil is actually giving bond yields a bit of relief, and domestic demand for Japanese bonds is rising. Plus, keep an ear out for market chatter hinting that Takeichi might be planning a consumption tax cut.
For USDJPY, the tactical play here is to sell at current levels. But because of that looming intervention risk, you have to maintain a strict stop loss at 164.11. If we see a break above that, it likely unleashes a rapid breakout targeting 164.60 and potentially beyond.
Now, what's genuinely fascinating is how Indian markets reacted. Amidst all this global drama, India essentially hit the snooze button. The rupee strengthened to a 2-week high, bolstered by a sharp intraday drop in Brent crude, intense RBI intervention, and a massive $40 billion in foreign inflows since early June. Even the 10-year government bond yield remained completely steady at 6.77%, showing real, undeniable fixed income stability.
For USDINR, that 3% intraday drop in oil and constant selling from PSU banks really helped the rupee find strong support right at the daily pivot of 95.67. So the tactical bias remains a buy on dips. You maintain that bias as long as 95.67 holds, and certainly until that major weekly support down at 94.87 bricks. Topside resistance is resting at 96.18.
Looking at Indian equities, the Nifty traded somewhat quietly, balancing IT gains against banking weakness. Technically, it remains a sell on rallies, with firm resistance at the 21-week moving average of 24,066. We're keeping a close eye on the 23,700 channel bottom for support, alongside that 24,900 level.
To wrap up today's explainer, let's look at the big picture we've just laid out. Given the explosive geopolitical backdrop erupting in the Middle East and tonight's massive Fed decision hovering right over us, we have to ask ourselves the million-dollar question. Are you positioned for a brief, buyable dip in tech, or are we witnessing a complete, fundamental regime change and rotation in global markets? Keep your technical levels tight and stay focused out there.